Non-fungible tokens, or NFTs, have become quite popular these days. These digital assets are selling like exotic Dutch tulips from the 17th century, from art and music to tacos and toilet paper. Some even sell for millions of dollars. But are NFTs worth the money, or are they just hype? Although some experts say NFTs are a bubble poised to pop, like the dot-com craze or Beanie Babies, others believe that they will change investing forever and are here to stay. Hello and welcome to the Finance Guardian channel. If you are interested in NFTs and want to explore more about what they are and how they work, you've come to the right place. Hit that subscribe button and the bell beside it, and let's dive in and see what all the fuss is about. As a special type of crypto asset, non-fungible tokens allow holders to prove ownership of real or virtual items, particularly the latter. This intangible item can include anything from virtual land plots in games, such as Sandbox and Decentraland, to digital artwork such as Beeple's Everydays, the 2020 collection to cartoon ape images. The average person might find this underwhelming, but you need to understand that in today's ever-increasing digital world, it's incredibly difficult to authenticate or exercise ownership over things that can be freely copied, screenshotted, or downloaded. Suppose you are a concept artist who creates digital artwork for gaming companies such as Ubisoft or Treyarch. If you were to sell your digital artwork online independently, you would need to create some means of marking and tracking ownership of your pieces so that purchasers could prove they were originals, not mere screenshots. Otherwise, why would you spend your money on such things? Here's where NFTs come in. But exactly what are NFTs? Essentially, non-fungible tokens are tradable digital assets and contain information stating that the person controlling this crypto wallet address owns the computer file stored in this location. As we have discussed, the company file may take the form of an image, a GIF, or an audio clip. NFTs are interesting because even if you make 1,000 copies of the same image or file and mint the same number of NFT tokens to represent ownership, each copy of the image will be unique from the rest of the 999 pieces thanks to the special information called metadata that is embedded in each NFT token. In other words, although 1,000 investors may have the same looking image in their wallets, each can say, "I specifically own copy number so-and-so." Picture it like an edition of a trading card with 1,000 exclusive copies, with each card having a serial number distinguishing it from the others. Additionally, the card bearing serial number 1 will likely be more valuable and desired than other cards in the edition if it is offered for sale. Incorporating different traits of varying degrees of rarity into the creation of these types of NFT collections further enhances the value and scarcity of the pieces in the collection. A creator may, for example, decide that 10 of the 1,000 pieces will have different colored backgrounds, and only one will have a patterned background. This will induce some buyers interested in investing in the collection to wish to own the collection's rarest pieces to increase their value over time, assuming that demand for the collection remains high. Another key characteristic of NFTs is their indestructibility. As all NFT data is stored on blockchain by smart contracts, the tokens cannot be destroyed, removed, or replicated. Furthermore, the ownership of NFTs is immutable, so players and collectors are actually the owners of their tokens, not the companies which created them. In contrast, when users purchase music from the iTunes store, they do not actually own the music they are purchasing. They simply purchase the license to listen to it. NFTs are also verifiable. It is possible to trace digital artwork back to its original creator by using historical ownership data stored on the blockchain, allowing pieces to be authenticated without the involvement of a third party. How do NFTs work? To create NFTs, a process known as minting is conducted, in which the NFT's information is published on a blockchain. In a nutshell, minting involves creating a new block, verifying the information of the NFT with a validator, and recording it. In this minting process, smart contracts are often incorporated to assign ownership and manage the transferability of the NFT. Tokens are issued with unique identifiers directly linked to one blockchain address as soon as they are minted. Each token has a designated owner and ownership information. The address where the minted token resides is publicly available. If 5,000 NFTs of the same exact item are minted, such as general admission tickets to a music festival, each of the tickets has its unique identifier that can be used to differentiate them from one another. Blockchain and fungibility. From a financial perspective, cryptocurrencies are usually fungible, meaning they can be exchanged or traded for another, just like physical money is. For example, one Bitcoin always has the same value as another on a given exchange, much like each dollar bill in the United States has a $1 implicit exchange value. Cryptocurrencies possesses the ability to be fungible, which makes them an appropriate medium for digital transactions. However, since blockchain technology provides the capability of storing and publicly communicating transaction history, not every cryptocurrency token or coin is the same. For example, there may be a premium attached to owning Bitcoin previously owned by Elon Musk, or a coin that has never been traded before. Collectors are willing to pay much more for something unique, similar to how a 1944 US steel wheat penny is only worth $0.01. Consequently, NFTs revolutionize crypto by making each token unique and irreplaceable, making it impossible to equal one non-fungible token with another. In addition to being digital representations of assets, tokens contain unique, non-transferable identities that distinguish them from each other, making them comparable to digital passports. They're also extensible, so you can combine two NFTs to breed a third, unique one. What is NFT used for? Other than crypto trading and collecting artwork, NFTs have some other uses as well, such as digital content. NFTs are most commonly used today in the digital content sector since NFTs support a creator economy in which content creators own their content rather than the platforms used to publicize it. Gaming items. NFTs have gained considerable attention from game developers due to their potential to provide a number of benefits to players. Normally, an online game allows players to purchase items for their characters. However, that is the extent of the service. With NFTs, you can recoup your money by selling the items once you're finished with them. Investment and collateral. NFT and decentralized finance, or DeFi, use the same infrastructure. DeFi applications permit you to borrow money with collateral. Both NFT and DeFi are now investigating the possibility of using NFTs as collateral. Domain names. NFTs provide an easier-to-remember name for your domain. It acts like a website domain name and makes your IP address more memorable and valuable, usually based on length and relevance. NFTs have gained wide attention even from celebrities such as Snoop Dogg, Shawn Mendes, and Jack Dorsey. These celebrities have released unique memories and artwork and sold them as securitized NFTs. Should you buy NFTs? Do you need to buy NFTs because you can? The answer depends. NFTs are risky due to the uncertainty surrounding their future and the lack of history to judge their performance. It may be worthwhile to invest small amounts to try them out for the time being. The decision of whether or not to invest in NFTs is largely a personal one. It may be worth considering if you have the money to spare, especially if a piece holds special meaning for you. But remember that an NFT's value is entirely determined by what another individual is willing to pay. Thus, demand will drive the price, rather than fundamental, technical, or economic factors, which typically influence stock prices and at least generally provide the basis for investor demand. The bottom line is that an NFT may resell for less than you paid. Or if no one wants it, you may be unable to resell it. Just as when you sell stocks at a profit, NFTs are also subject to capital gains taxes. However, since NFTs are considered collectibles, they may not receive the preferential long-term capital gain rates that stocks receive. They may even be taxed at a higher collectibles tax rate, although the IRS has not yet determined how NFTs should be treated for tax purposes. It's also important to remember that the cryptocurrencies used to purchase the NFTs may also be taxed if their value has increased since you purchased them. So you should consult with a tax professional before adding NFTs to your investment portfolio. That said, treat NFTs like any other investment, do your research, understand the risks, including the possibilities of losing your entire investment, and proceed with caution if you decide to take the plunge. And that is all the time that we have for today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new, subscribe to our channel to remain updated about our future videos. We'll see you next time.